What happens when a market stops being priced by promises and starts being priced by delivery? Because that's the fault line running under silver right now. Not a chart pattern, not a hot take, a plumbing problem, a settlement problem, a credibility problem. And when the pipes start to groan, the smartest capital doesn't argue on Twitter. It quietly moves into the assets that reprice when the old system can't pretend anymore. Welcome to Junior Mining Gold, the podcast where we dig deep into the raw, unfiltered world of building fortunes from the ground up. I'm your host, Dusty Nugget, the guy who's ridden more boom and bust cycles than a rodeo cowboy on a bull named Recession. If you're new here, we don't sugarcoat the grind. We expose the guts of business, from solo hustles to empire-building shares. Before we dig into the dirt, this episode is brought to you by JuniorMining.gold. Are you tired of missing the boat on the next big discovery? JuniorMining.gold is your ultimate radar for the high-stakes world of small-cap mining. We track the drills, the assays, and the movers so you don't have to. If you want an edge, head over to JuniorMining.gold. Now, let's get to the gold. Today's episode is a read-through of an experienced mining investor's playbook, Eric Sprott, and what his worldview implies right now for silver and for the broader map of where hard asset capital is drifting in 2026. And here's the frame I want you to hold in your head the whole way through. Silver isn't just a metal. Silver is a market structure. It's an IOU stack. It's paper claims sitting on top of physical inventory. And the Sprott-style thesis, the one echoing through the sector, is that we've moved from a world where paper supply could always smother price to a world where more participants are effectively saying, "Great, show me the ounces." That's the core of what's being described as a decoupling, a shift from financialized pricing toward physical scarcity and physical premiums. Now, we're going to connect two big things today. First, the silver regime change, and why India just made a regulatory move that matters more than 1,000 Western headlines. The Securities and Exchange Board of India opened the door for equity mutual fund schemes to hold meaningful exposure to gold and silver instruments, up to 35% of the residual portion of assets, which quietly institutionalizes a persistent bid inside a giant domestic savings machine. Second, how we use Sprott's filings, 13F, and the heavier tell signals like 13D and insider activity to understand what smart, patient capital is actually doing in mining. Because the filings don't predict tomorrow's price. They tell you what kind of world the allocator thinks we're moving into. Let's start with silver. In the report we're working from, the great silver decoupling is framed as a structural shift, permanent backwardation pressures, institutional fragmentation, and a weakening of the old suppression mechanism where paper ounces could be issued in size to cap rallies. You can take the drama level up or down, but the investor takeaway is clean. When a market's claim structure gets too stretched, the repricing isn't gentle. It's discontinuous. The paper price stops being the whole story, and the physical market starts speaking louder through premiums, delivery stress, and behavior changes. And the reason Sprott watchers care is simple. In a true physical-first regime, primary silver miners don't just benefit, they flip. They go from levered optionality to cash flow torque, fast enough that capital rotation becomes violent, the setup for a massive mining sweep. Now here's the demand-side fuel that makes this story bigger than COMEX LBMA narratives. The Securities and Exchange Board of India's late February circular changes what Indian mutual funds can hold, and for our purposes, the headline is that actively managed equity mutual fund schemes can invest up to 35% of residual assets in gold and silver instruments. That sounds like a footnote until you translate it into market structure. It moves precious metals from cultural savings behavior toward portfolio allocation policy. It invites systematic buying behavior into a market that has historically been hypersensitive to marginal physical flows. And the Securities and Exchange Board of India didn't stop at allocation. The report notes a related move, shifting valuation norms toward domestic spot pricing for precious metal ETFs. In plain English, less outsourcing of price discovery, more local anchoring. Here's the investor translation. This isn't India bought some ETFs. It's India legitimizing precious metals as a sleeve inside institutional portfolios and tightening the connection between domestic demand and price formation. If silver is already tight, That kind of structural bid doesn't need to be huge to matter. It just needs to be steady. Now, let's pivot to the second half, how we read Sprott's filings and what the portfolio tells us about his map of the future. The Sprott 13F Mining Investments Analysis frames activity from 2020 through early 2026 as hard asset allocation shaped by debasement risk, deglobalization, and friction in supply chains and settlement systems. The key move for you is not memorizing tickers, it's recognizing the buckets. Bucket 1. Core precious metals exposure, producers, developers, and the royalty streaming backbone that turns metal cycles into durable cash flows. Bucket 2. District scale optionality, big land packages, big systems, this could become a camp profile. Bucket 3. Critical materials, uranium, copper, rare earths, bottleneck inputs that become geopolitical leverage when inventories tighten. Quick mechanics note. A 13F is a quarterly snapshot of certain U.S.-listed positions. It's useful, but it's not the whole book. That's why it matters to pair filings with higher signal markers like insider activity and, where relevant, 13D-type accumulation behavior, because those patterns are often the earliest proof of conviction. All right, portfolio walk, and I'm going to do it like an experienced investor does. What it is, what it means, and what would plausibly move the needle. Start with the strategic backbone. Hycroft Mining is one of the most direct silver optionality expressions in Nevada, a giant system with a legacy oxide story now trying to earn credibility as a sulfide scale opportunity. Its scale in ounce terms is enormous, and recent exploration has highlighted higher-grade silver systems like Brimstone and Vortex that are open for expansion. The catalyst concept is straightforward. This is a re-rate story if the technical path de-risks and the high-grade silver narrative keeps tightening into something that looks mineable, not just mappable. Newfound Gold is the Newfoundland district-scale bet. Queensway as the core, plus a strategic acceleration move via Hammerdown and the Pine Cove Mill to compress the timeline toward production. For investors, the catalyst stack is always the same. Drill for continuity, engineer for credibility, build infrastructure for schedule, and keep capital discipline so you don't get diluted into irrelevance. Then you've got the producers, the keep the lights on sleeve. There's a revealing tilt here. More emphasis on North American producers and developers as a response to resource nationalism and permitting uncertainty. Translation: in 2026, jurisdiction isn't boring, it's valuation. Agnico Eagle fits the compounding machine archetype, the operator that survives because it replaces reserves with the drill, not with slide decks. Alamos Gold slots into the same duration in good neighborhoods logic. Barrick is senior exposure and liquidity, the kind of holding that can absorb capital and still provide precious metals beta. Coeur is a different flavor, more operational torque and project cadence, the kind of name that can surprise hard in either direction depending on execution. And then names like Equinox Gold and IAM Gold represent the execution-sensitive operating leverage sleeve. If they hit plan, the equity breathes. If they miss, the market sharpens its knife. Now the risk management tell, royalties and streaming. Wheaton is there because it captures upside to metals without carrying full operating risk, a business model that tends to look smarter when operators are wrestling with capex inflation and sustaining costs. Royal Gold is similar, diversified royalties, cash flow durability, and the ability to benefit from expansions without paying for the expansions. Elemental Altus is the junior compounder angle, a portfolio-building strategy that can quietly shift valuation as cash flows become more visible. Now we hit the part that matters most. If you believe in a physical-first silver regime, silver producers and silver developers with torque. Mag Silver shows up because Juanicipio's real, high-grade, and already operating. In a stronger silver tape, the catalyst isn't one drill hole, it's consistency, margins, and the market re-rating cash flow quality. Silvercrest is the profitable producer angle. When silver moves, clean operations print free cash flow, and free cash flow is what brings generalist capital back into the sector. Vizsla is the developer torque name. The key investor question here is always whether the project earns payable ounces credibility, meaning metallurgy, mine plan, and financing pathway all hold together. Discovery is the scale developer expression. The catalyst is how quickly a massive project can move from too big to fund to too big to ignore when prices, policy, and strategic capital align. Andean Precious Metals is producing exposure in Bolivia with an acquisition angle. The catalyst stack becomes operational performance plus corporate action, and the market's willingness to pay for it. Now zoom out and you'll see the worldview isn't just silver, it's bottlenecks. Chemical is uranium, energy security and contracting cycles. Aero copper is electrification torque with a commissioning story embedded. Taseco is Gibraltar plus Florence copper. And Florence's in-situ recovery design is exactly the kind of architecture that can survive the next decade of permitting constraints. MP Materials is the rare earth supply chain piece, strategic materials, processing ambitions, and national security adjacent demand. And then, the long-duration optionality sleeve, the stuff that looks irrational until the world changes, and then it looks early. International Tower Hill, Free Gold Ventures, Northern Dynasty, and smaller optionality names that fit the stay patient, let the macro do the work basket. Which brings us to the newest ad, American Eagle Gold, and this one deserves a clean underline because it's not portfolio drift. It's a fresh, funded intent statement. American Eagle announced a strategic investment backed by Eric Sprott, about $23 million Canadian, with Sprott, through a corporation beneficially owned and controlled by him, agreeing to acquire roughly a 9.9% equity interest via 19.2 million shares, explicitly to fund significantly expanded drilling in 2026 and 2027 at the NAC Copper-Gold Porphyry project in British Columbia. That's not a passive bet, that's a let's go find out what this really is check. And if you're building a Sprott mental model, here's the relevance. Copper porphyries are long-duration, scalable choke point assets in a world of electrification constraints. When he steps in like that, it's consistent with the broader map. Own the bottlenecks, own the duration, own the optionality that becomes inevitable if the macro stays tight. So what's the whole episode takeaway? If silver is drifting toward a physical-first regime, and the Securities and Exchange Board of India is institutionalizing precious metal demand through regulation, the upside for silver miners isn't just higher prices. It's a re-rating of the equity complex. More capital willing to pay for credible ounces, for cash flow, for projects that can actually get built. And when you read Sprott's filings with that in mind, you see a barbell built for this exact world. Royalty and streaming durability on one side, convex developer and exploration torque on the other, and a critical materials sleeve that treats uranium, copper, and rare earths as strategic scarcity assets rather than cyclical trades. All right, let's bring it home to what we're doing at JuniorMining.gold. In the show notes, we're linking 2 silver projects we're actively analyzing on JuniorMining.gold, Alaska Silver and Minorum Silver. Those are our case studies for how a physical-first silver regime changes valuation math, metals, jurisdiction, capex realism, financing pathways, and the catalyst calendar that tells you whether a story is about to earn credibility or about to raise money again. This is Dusty Nugget. Remember, mining fortunes aren't built by guessing next week's candle. They're built by recognizing when the rules of the market are changing and owning the assets that reprice when the old system can't fake it anymore. Stay bold, stay scrappy, and I'll see you at the next drill site. You can learn more at JuniorMining.gold. Please like, subscribe, and visit our socials or our Substack for more content.